investment rate risk with respect to maturity. Okay, so as you know, interest rate risk is lower in the short-term bond and higher in the long-term bond, whereas the reinvestment rate risk is higher in short-term bond and lower in the long-term bond. So we figured out the interest rate risk and reinvestment rate risk in terms of maturity. And today we will figure out the interest rate risk and reinvestment rate risk with respect to coupon. Okay, so let's assume there are two bonds, A and B. So bond A provide 10% of coupon, bond B give 1% of coupon, and we assume that market interest rate is the 5%, for example, and the maturity is 3. For example, maturity is 10 years bond. Then we have 100 at time 1, 100 time 2, 100 time 3, 100 time 10, and the principal 1000. That's the cash flow stream that we will receive if the bond whose coupon is 10%. Bond B give just 1% of coupon, then we will receive the $10 at each year during the last 10 years for the next 10 years. And then in maturity, we receive 10 as interest, 1,000 as the principal. Okay. So now let's figure out reinvestment rate risk first. Reinvestment rate risk can happen when the interest rate is decreased, right? If interest rate is decreased, coupon rate is also decreased. So reinvestment return is going to be decreased. So we better choose 10 years maturity bond rather than 1 year maturity bond, right? So the reinvestment rate, in terms of reinvestment and reinvestment rate risk, if the interest rate is decreased to the 4% from the 5%, then out of 5%, 4% is the 20% decrease, right? So from 5% to 4%, then the 20% of 5% is decreased is going to be 4%, right? So if the coupon decrease is proportional to the market interest rate decrease, then 10% is going to be 8%, right? 20% down. 1% decrease 0.8% because the 20% are down, right? Then we will receive $80 if the coupon rate is 80%. 8%. If coupon is 0.8%, it's gonna be 8, right? This is the difference. This is only $2. Difference is $20, right? So which bond has the more impact of the market interest rate decrease? Definitely this one, right? So if coupon interest rate is higher, then those kind of bond has more impact of reinvestment rate risk. Okay, whereas if the coupon is lower, then the reinvestment rate risk is lower, right? So the coupon interest rate is positively related to the reinvestment rate risk. Okay. And another one is the interest rate risk. Interest rate risk, or is also named as price risk. Price risk means that if RD is increased, then price is decreased. So the risk to decrease the price is called as interest rate risk. Okay. Then let's compare bond A and bond B. Bond A provide higher coupon, bond B provide lower coupon. Then total value of A can be calculated by, for example, 10 divided by RD plus 100 divided by RD plus 100 divided by RD square. 100 divided by 1 plus RD to the power of 3. 110, 1100 divided by 1 plus RD to the power of 10. That's the bond value A. How about bond B? Bond B price is the 1 divided by 1 plus RD. 10 divided by 1 plus RD. 10 divided by 1 plus RD square. 10, 10. 1010 divided by 1 plus RD to the power of 10. Okay. Now, if RD is increased, if the interest play role as the denominator, if RD is increased, the last term can be affected by change of interest most, right? So the most impacted term, if RD is changed, is the last term, right? Because it's the 10 to the power of 10. So if RD is changed a little bit, but this is 10 to the power of 10, then the last term can be affected, most affected from the change of interest rate. Okay, then we need to think about then the portion of last term out of total value. Okay, let me think about the total, the portion of the last term value out of total value. Then if the coupon is higher, and so let's compare this one and this one. So let's the bond B first. Let's take a look at the bond B first. So if the coupon interest rate is low, just like 10, 10, 10, then, but the last time is 10, 10, 1010, then this one can be affected, by change of interest more than this term, right? Because it's 100. So if we ignore the time value money, then this is the what? The interest rate is 100 times 10 is 1,000, for example, right? If we ignore the time value money, the sum of interest is 1,000, principal is 1,000. Then if we ignore the time value of money, then this value out of total value is 1,100 divided by 2,000. It's about 55%, right? How about the bond B? It's 10 times 10 is 100. The principal is 1,000. Then the amount that we will receive the last time is 110, 1010 divided by 100. It's gonna be about 90%. Okay, so this term can be affected more if the RD is changed. Okay, so if RD is decreased, the amount of price increase amount of decreased price is in B is much bigger than A. So we'll say B is more sensitive with respect to interest rate is decreased, which means interest rate risk, right? So we'll say B is more sensitive with respect to interest rate risk. So if the coupon interest rate is low, then it's the more sensitive with respect to interest rate risk. Whereas if the coupon is higher, then the less sensitive with respect to interest rate risk. So if we summarize what we talked about so far, that's gonna be in terms of coupon, high coupon bond has the high reinvestment rate risk, but the low interest rate risk. Low coupon bond has the low reinvestment rate risk and the high interest rate risk. Simultaneously, in terms of a coupon bond, the reinvestment rate risk is higher in high coupon bond, lower in low coupon bond, whereas interest rate risk is lower in the high coupon bond, higher in low coupon bond. So if you compare this one and this one, this one and this one, or this one and this one, and this one and this one. So if you compare the based on row, a column, this column and this column, or if you compare by row, this one and this one, this is the Y bar, right? So we would say nothing is riskless. So if we take something, then we have the another weak point in the another dimension. Okay, so we would say nothing is riskless. We would say just like that. Then how can we avoid those kind of interest rate risk and reinvestment rate risk by using duration. So we will talk about duration more detail in the investment class, not in the financial management class. So there's some the equation to calculate the duration. But at financial management course level, just I will let you know just definition of duration. So page number 340, if you take a look at the page number 340, there is a definition of duration. Duration is the weighted average of the time, it takes to receive each of the bond's cash flows. In other words, we would say this is a period that we receive our money back. We received our money back. The period that we will receive our money back is defined as duration. So if we ignore the time value money as well, ignore time value money, then if we have 3 years maturity bond, then and the coupon interest rate is 10%, then we will receive 100 at the end of first year, 100 at the second year, 1,100 at the third year, right? The amount that we will invest is 1,000, right? So duration means when we can receive our money, in this case 1,000. And if we ignore the time value money, we can receive 100. Then cumulative amount that we receive is 200 until year 2, right? And year 3, 1,100. The remaining one to receive our original invest money is 800. 800 is not the insufficient, right? So 800 divided by 110 is about 77%, right? 77.77, right? Then we will say in this case duration is 2 plus 0.77 is going to be 2.77 years. This one is duration. If we ignore the time value of money, right? So, within the 2.77 years, we can receive our original invested money, right? Even if the maturity is 3 years, we can receive all money that we invest in 2.77 years. That is called as duration. Okay, so if we use the duration, we can avoid the reinvestment rate. I mean the interest rate risk. We remove interest rate risk if we use the duration. How come? If you take a look at the last paragraph in page number 340, one way to manage both price and reinvestment risk is to buy a zero coupon bond, zero coupon bond, zero coupon treasury bond with a duration equal to the investor's investment horizon with, if you match the duration and investment horizon, which means just like that. If you need the money to invest in 2.77 years, for example, if you have planned to, we say you should use $1,000 in 2077, $1,000 in 2077, then we can receive 100, 100, and the duration is, if the duration is 2.77 years, then we would say we can receive $1,000 in 2077 year, and this $1,000 can be reinvested in 2.77 years, right? So if duration of our bond is just a match to the amount, the money that we will need, then we can avoid interest rate risk. Because if the interest, the RP is the increase, then the price is decreased, right? Then price is decreased, then we'd say the amount that we need we use in 2007 2.77 year is also decreased. Okay, so if we match the asset and liability with same duration, then we can avoid the interest rate risk. That's the one way to remove avoid the interest rate risk. And if we buy the zero coupon bond, then originally if there's no coupon, then which is not exposed to reinvestment rate risk, right? Anyhow, zero coupon bond is what? Originally, we started from no reinvestment rate risk, right? Because there's nothing, right? There's nothing to receive the coupon during our investment period, so we don't have to worry about the interest rate is decreased. Okay, so if we buy zero coupon bond with duration equal to investors' investment horizon, then we can avoid both interest rate risk and reinvestment rate risk, which is one way to remove those kind of risk from interest rate change. Okay, that's the duration, we figured out that duration, using duration to reduce the price risk and the reinvestment rate risk, right? Okay, and last topic is the default risk. Default risk is if one issuer defaults, investors receive less than the promised return, right? So if the company, I mean the company that issue the bond is bankrupt, then we cannot receive the interest and principal thereafter, right? So therefore, the expected return on corporate and municipal bonds is less than the promised return, influenced by the issuer's financial strength and terms of bond contract. So, you know, the credit rating is reflected on financial strength of the company. So the credit rating agency will say CRA, credit rating agency. The most popular credit rating agency is Moody's, S&P, and Fitch. There are three popular credit rating agency. Credit rating agency, 신용평가사 in Korean, rating agency. So those credit rating agency give the credit rating to the company as well as even the country, right? So we sometimes compare the countries, the credit rating. So that country's credit rating can affect what? Interest rate of the government bond, right? Government bond. So if credit rating is higher, good grade, then the cost of raising fund is lower, right? So definitely triple A, if we compare triple A's bond, double B's bond, definitely coupon of double B's bond is much higher than the triple A's coupon rate, because the meaning that the coupon interest rate is higher is what? The default risk is higher. Okay, so if credit rating is lower, then the company should provide higher coupon interest rate. Otherwise, that bond cannot be sold to the public. Okay, so that logic can be applied to the government bond as well. So I'm not sure, but the Korean credit rating is double A, which is the higher than Japan's credit rating now, as long as I know. Yeah. So Korean credit rating is higher than Japan's credit rating. Wow, we won, we win. 오케이, right. 아, 여기 일본 학생 없지? There's no Japanese, right? Okay, yeah. So 이거 말 조심해야 돼. Alright, so and the Moody's and S&P, there's some the grading system is a little bit different. So Moody's is triple A, double A, single A, BAA, BAB, something like that. But whereas S&P grading system is triple A, double A, single A, triple B, double B, single B, just like that. So we would say if the bond credit rating is higher than the triple B, is classified by investment grade, whereas the bond with credit rating whose credit rating is lower than double B is classified by junk bond. So definitely junk bond provide higher interest rate, coupon interest rate, and the junk bond cannot be sold very well. So some financial instrument can combine good grade bond and bad grade bond, such as some financial instrument has the combine of double A bond and single B bond. This is one financial instrument. The name is CLO. collateral obligation, CLO. So for example, CLO, which is the sort of the bond, but we'll say the structured note. We'll say structured. So in CLO, there's a tranche, tran, tranche in French, tranche in French, tranche in French, tranche in the English. So there's some the level, okay? So there's some the order to receive the interest and principal. So even if this CLO is combined two bonds, but the holder is the separately. So if the the senior there are three tranches, four tranches, tranche. So the 프랑스에서 왔지. Whole comes from France, right? Whole. Yeah, my pronunciation is correct.
Yeah,
Tranche.
perfect.
Yeah, perfect. See, yeah, tranche. Okay. Anyway, so there's the order to receive the interest and principal. So definitely double the holder with a double A bond receive the interest and principal earlier than the bond holder with the double the single B bond. So there's the differentiate to receive the interest in principal by using an on tranche. Okay, so there's those kind of financial instrument we have. Okay, so the bond ratings are designed to reflect the probability of bond issue going into default. So the credit rating agency provide credit to the companies who want to issue the bond, or even the government or the local government, something like that, right? That's the bond. Any question about bond? Any question about bond? Then we will move on the chapter 11, cost of capital. Okay, cost of capital. It's the first chapter in part 4, right? Part of capital budgeting. So capital budgeting is long-term investing in long-term asset. As I explained the first class, when I explained the syllabus, capital budgeting is very, very important issue, especially the corporate financial officer. Okay, so capital budgeting are associated with huge amount and long-term period. Okay, so if the company make decision to go to the new business area or expand their facility, their factory, then they should make decision whether or not we should go, right? That those kind of decision is called as capital budgeting. So in capital budgeting, companies spend a lot of huge amount of money, which is called as capital expenditure, capex, capital expenditure, for the during the long time, right? During the long time. So one of the most important factor to make the decision whether or not we accept, we accept project or we can enter the new business area is the cost of capital. Cost of capital play a role as the hurdle rate, right? So to accept the project or to enter the new business area, our expected return should be higher than cost of capital, right? Then go. If the expected return is lower than cost of capital, don't go, right? So the cost of capital play a role as the hurdle rate to accept the project. Okay, it's a very, very important thing. And I already, from time to time, I introduce the cost of capital, right? So AACC, AACC is the cost of capital, weighted average cost of capital. That's the cost of capital. AACC, weighted average cost of capital. So from time to time, we talked about already cost of capital. Okay, so let's take a look at the cost of capital. In this chapter, we will talk about the sources of capital, components of cost, and the WACC, WSCC. And what happened if we consider flotation cost? Flotation cost is issuing cost. Issuing cost. If we consider the issuing cost, what happened in terms of cost? And the final final topic is adjusting for risk. How can we adjust the risk? That's the final last topic covered in this chapter. All right, so let's take a look at the sources of long-term capital. So in short-term capital, the major resources for short-term capital is we can borrow the money from the bank, right? We can borrow the money from the financial institution, but the long-term capital, we can borrow the huge amount of money from, we cannot borrow a huge amount of money from the bank for the long time, right? So long-term capital, there are three resources of long-term capital. We may issue the bond. That's going to be debt, long-term debt. We can issue the preferred stock. That's a preferred stock. We can issue the common stock, right? Common stock. So there are three major resources to raise a fund, right? And another important thing is the common stock can be decomposed into two parts. We may use retained earnings, or we may issue the new common stock. Both of them are included in common stock. Okay, common stock, right? So why we need to distinguish retained earnings with the new common stock, as I will let you know in the last part of this chapter 11. Okay, so if we generate the return profit, let me explain later on. Okay, anyway, so long-term debt, preferred stock, and common stock. Common stock can be decomposed into two types: retained earnings. We can use retained earnings, or we may issue the new stock, common stock. So the weighted average of cost of capital, this is the cost of capital. Then cost of capital can be calculated by weighted average of three resources: debt, preferred stock, and common equity. Right? So W in this equation, W refer to the firm's capital structure weight. W means weight of the amount we raise a fund by using debt, the amount weight, not amount. Wait to raise a fund by using debt. Wait to raise by using preferred stock. Wait to raise by using common equity. Okay, and R means cost of each component. This is called as cost of debt. This is cost of preferred stock. This is cost of common equity. Cost of common stock. But you guys, wondering why this debt? So D stands for debt. That D. P stands for preferred stock, right? Then why in this equation suffix of double is C, suffix of R is S? What's that mean? C is common equity, S is stock. Why is not identical? WCRC or WCSRS. I will let you know. Okay, I will let you know. So this is a RC. Originally, this should be RC. RC can be decomposed of RS and RE just by notation, right? RS and RE. Then why we do not use RC instead of RC? Why we use RS? RS means cost of retained earning. RE is the cost of new common equity. So here you go. This is expressed by RD. This is expressed by RP. This is expressed by RS. This is RE. This is RC. Right? So originally RC, it is more likely to use RC, but why we use RS? Generally, if we use the common stock, generally 90%, 99%, 90%, more than 90%, higher than 90%, we can use retained earnings. That's why we use RS, right? But originally this should be RC, but the reason why we use RS instead of RS instead of RC is because of the, even if common stock, the resources to raise a fund by using common stock is two types, retained earning and the new common stock. But retained earning is more popular. To use the retained earning is more popular, so we use the RS instead of RC. All right. So anyway, R stand for means the cost of each component. Then, and we need to focus on after-tax cost and the marginal cost, which means stockholders focus on after-tax cash flows. Therefore, we should focus on after-tax capital cost. In other words, use after-tax cost of capital in AACC. Only RD need adjustment because the interest is tax deductible. What's that mean? Interest is tax deductible. This is the pretty important thing. Tax deductible means okay. Now let's compare case A and case B. EBIT, for example, EBIT is 10, for example. But Form A should pay interest as much as 4, but there's no interest in Form B. So we will say there's no debt company, right? No debt company. 무부채기업 in Korean, no debt company. Then EBT is 10 minus 4 is 6 because we spend $4 as interest and the EBT is $10. And tax, if we assume the tax is 30%, then we need to pay tax 6 times 0.3 is 1.8. And in form B, 10 times 3, 30% is 3, right? So net income is 4.27. It's easy, huh? So if we compare form A and form B, see, even if form A pay the interest as much as 4, okay, but the net income, the difference between A and B's net income is not 4. I mean the 4, right? Because the A spend more money as much as 4 as interest, but A's net income is not 3, right? Oh, why is that? If B's net income is 7, then A's net income should be 3 because we pay the interest as much as 4, right? So 7 minus 4 should be 3, but the net income is not 3. Net income is 4.2. 4.2 is higher than the 3. Why is that? That's the tax deductible, tax effect, tax deductible, which means interest times 1 minus the 30%. Tax rate is 30%, right? So 4 times 3 is 1.2, right? So this gap is 1.2, right? That's a tax deductible. In other words, if interest is 4, but the amount to be considered in net income is not 4, but 2.8, right? So 1.2 cannot be recognized as cost out of 4, right? So we'll say 70% of interest can be considered as cost, right? So 4 times 7 is going to be 2.3. Even if the A paid $4 as the interest rate, but only 2.8 can be regarded as cost. Okay, so this get 1.2 is gonna be tax deductible. So when we consider cost of debt, then we cannot recognize whole RD, but RD times 1 minus T. We should recognize the cost as RD times 1 minus T. In this case, if tax rate is 70%, 30%, then 70% of cost of debt can be recognized as cost because of tax deductible, right? So when we calculate the cost of debt, we should recognize the tax effect. That's a tax deductible. Okay, tax deductible, right? And the cost of capital is used primarily to there's tax deductible. It's used primarily to make decisions that involve raising new capital. So focus on today's marginal cost, which means focus on today's marginal cost means what? You don't have to think about the historical cost. You don't think about the historical, you don't have to think about the historical cost. If we raise new capital, right? If we raise new capital, how much money we should pay? That is called the marginal cost, right? So from now on, we don't have to pay if we do not consider the new project, right? So the reason why we consider the raising the fund is because we need the money when we start a new project, right? So marginal cost means if we plan to raise new capital, how much money we need to pay? That's the marginal cost. Okay, so we don't have to think about the past cost. From now on, when we start new project to raise a fund, then how much money we should pay? That's the marginal cost. Okay, so be careful about the interest rate has some tax deductible effect, and you should focus on the marginal cost to calculate the cost of capital, right? And another important thing is how are the weights determined? Let's take a look at one by one. Let's take a look at the weight first. This is the weight to raise a fund by using debt, weight to raise a fund by using preferred stock, weight to raise a fund by using common equity. Then, which number can be used? Accounting number and market value. This means the same question, book value or market weight. Which one is more relevant information? 준서, which one is more relevant information? Accounting number or market value? Book value or market weight? Yeah?
I think it's market weight.
Yeah, exactly. Good. So sometimes we ignore the accounting, right? Accounting is very lower knowledge, right? Compared to the finance, right? It's kidding, yeah. All right, so the market value is always changed, right? So if the stock price goes up, then the market weight is gonna be, the increase, right? So we need to focus on market value, market weight, okay? And in terms of capital structure, which one is more important? Actual number or target capital structure? Actual number means current capital structure. Actual number is current capital structure, means current capital structure. So we will talk about this issue more detail in chapter 15, capital structure, which is the last chapter we covered in this course. Chapter 15 is the last chapter we will cover. So we need to know the target capital structure. So we should focus on not current capital structure, but target capital structure. We need to focus on the not current capital structure, but target capital structure. Then what's target capital structure? Target capital structure, the definition of target capital structure is page number 408. Before that, capital structure means the weight of each resources, right? So what is the weight of the debt, weight of preferred stock, weight of common equity? That's the capital structure, okay? And the target capital structure is the mix of debt, preferred stock, and common equity. The firm plans to raise to funds its future project, right? Planned capital structure is target capital structure. So to understand target capital structure, we need to know the optimal capital structure. The definition of optimal capital structure is the chapter 15, page number 337, 537, 537. There is the optimal capital structure. Optimal capital structure is the capital structure that maximizes stock's intrinsic value. So as you shall see in chapter 15, each company has its own optimal capital structure to maximize firm value. So firm value can be different depending on capital structure. So some capital structure that maximize their firm value is called as optimal capital structure. Okay, so let me give you an example. Here we go. Current capital structure is the common stock, bond, preferred stock. So total long-term capital is 60, for example, 60. And the current capital structure of common stock is 30. Bond is 24. Preferred stock is 6, for example. Then common stock is what percent? 50%. Bond is 40%, right? Preferred stock is 10%. That's the current capital structure. So if this company's optimal capital structure is the common stock is 60%, bond is 30%, preferred stock is 10%. Optimal capital structure is as follows: 60% for common stock, 30% for bond, 10% for preferred stock, for instance. But the current capital structure is 50% of common stock, 40% of bond, 10% of preferred stock. Okay, now the company has planned to raise a fund as much as 40. Then total, after raising new capital, total long-term capital is gonna be 100, right? Current long-term capital is 60. The amount that the company planned to raise new capital is 40. Then after raising the capital, the long-term capital is going to be 100, right? Then, in terms of optimal capital structure, common stock should be 60, right? Bond should be 30. Preferred stock should be 10. Okay? Then, how much we raise a fund by using common stock in this case? Virginia, how much money we should raise in terms of common stock?
I don't know.
You don't know? You don't know. You don't. Yeah. From 30 to 60, how much money we need? 30. 30 plus 30 is going to be 60, right? 24 plus something is 30. 6 is 30. 6 plus 4 is going to be 10. Right? So this is current capital structure. This is the optimal capital structure. The ideal capital structure. Okay? Then this is called as target capital structure. So when we plan to raise new capital, how much money wait to raise each resource is called as target capital structure. So 30 out of 40 is going to be 75%. 6 out of 4 is 15%. 4 out of 10 is 10%. So target capital structure is 75%, 15%, and 10% with respect to common stock, bond, and preferred stock. So this is the target capital structure. So when we calculate the WACC, in that equation, W is this rate, 75, 15, 10, target capital structure. Not current capital structure, not optimal capital structure, but target capital structure, right? So we should pay attention to the target capital structure. Okay, So in this case, this is the, what was that? 15%. This is 10%. This is 75%. Okay, so those kind of figure can be used as weight. Okay, so you need to focus on the market value and the target capital structure. Now, the capital structure I already explained that on. Now let's take a look at the one by one. So that we figured out the weight W, right? WD, WP, WC. So in this the PowerPoint, we need to focus on the cost of debt. So as I told you, cost of debt, when we calculate the cost of debt, we need to think about the tax effect as well, right? So RD is a marginal cost of debt capital, RD. So yield to maturity, you are familiar with yield to maturity, right? Yield to maturity is the the yield to maturity on outstanding long-term debt is often used as a measure of RD, yield to maturity. That's it. RP, preferred stock. RP is the marginal cost of preferred stock, which is the return investors require on firm's preferred stock. So RP is preferred stock. And the RS is a marginal cost of common equity using retained earning. So as I told you, so cost of external equity using new common equity is RE. Okay? So RC can be decomposed of RS and RE. Right? So this is the RS, this is the RE, this is the RC, as I told you. So, but some of you guys are confused. Why we need to recognize the cost, even if we use the retained earning within the company, right? That's the lockup money. But if we use lockup money, but why we should recognize those kind of things as cost? See, let me explain that on. It's a profit, right? So some part of profit paid to the shareholders as the name of dividend. And some part of profit can be retained to reinvest. Okay, so this one is go away. Okay, and if we retain the retain earning within the company, and if we use this one, right, then we should recognize this one is RS. Okay, why is that? Because opportunity cost. Opportunity cost. So see, this profits essential is identical, right? This profits essential is identical, regardless of dividend, retained earning. Okay, but if this profit paid to the shareholders as dividend, this money can be reinvested in some other financial instrument, then they can make the return, right? So we need to recognize these retained earnings just same as there is the return that the dividend is reinvested. We will say this is opportunity cost. Furthermore, if these shareholders invest their dividend in this same company, then they can ask, give me the return, right? So particularly if these shareholders invest their dividend in this company, okay, then we need to recognize cost. Okay, so the same thing. So even if this money is retained within the company, but if we use this retained earning, then we should recognize as cost. Especially this is opportunity cost. This is RS. So even if we use the, within the company, money within the company, we should recognize cost. Okay, so that's the reason, opportunity cost. So why is there a cost for retained earnings? Earnings can be reinvested or paid out. This is retained. This is a dividend, paid out as dividend. Investors could buy other securities on return, may earn a return, right? So if earnings are retained, there is an opportunity cost, as I told you. The return that stockholders could earn an alternative investment and equal risk. Especially investors could buy similar stock and earn RS, or firm could repurchase its own stock and RS. That's what I told you. So this is we need to recognize the opportunity cost, even if we use the retained earning, right? Then how can we calculate the RS? These three ways, but I let you know the two ways. The other one is the bond yield plus risk premium. I erased because this is the ballpark estimation. So in reality, it's not used, but just for your reference, bond yield plus risk premium. In this equation, risk premium is not equal to risk premium when we calculate the CAPM. This is market risk premium, right? And RS minus RF is the risk premium of asset. But in this equation, risk premium in this word, the risk premium is not equal to that one. Okay. So let's take a look at the three ways to determine cost of common equity RS. So you are familiar with this one, right? So before the chapter 10, we would say RS is what? Required rate of return. As I told you several times, this required rate of return is measured from the point of investor. Okay, so until that, so far we would say this is a required rate of return, but from the point of the company, this is what? Cost of capital, cost of common equity, Okay, so name is changed, name is the changed, but the essential is same thing, identical. From the point of the investor, this is gonna be required rate of return. From the point of the company, and that borrow the money, that is gonna be cost of common equity, right? So how can we calculate cost of common equity? Which means that how can we calculate the required rate of return? Required rate of return we already covered, right? So the CAPM RS is RF plus RF minus RF times B, or discounted cash flow. This is dividend discount model. So we already figured out dividend discount model. If the dividend grow at a constant rate, then stock price is D1 divided by RS minus G, right? So if we rearrange this one, then RS minus G equal to D1 divided by P0. The change, the numerator in the P0, and RS equal to D1 divided by P0, plus if we move the left-hand side to the right-hand side, and the cost of common equity can be calculated by D1 divided by P0 plus growth rate. Okay, growth rate. So here's the example. See if risk-free rate is 6%, market risk premium is 5%, and the firm's beta is 1.48, then what is the cost of common equity based on CPM? It's simple, right? Risk-free rate is 6%, market risk premium is 5%, beta is 1.48. So the cost of common equity is 13.4%. If we use the dividend discount model, the dividend cash flow model, then the dividend that I received in the most recent year is 1.15. Current stock price is $23. Growth rate is 8%. That's the cost of common equity based upon a discounted cash flow approach. RS equal to D1 divided by P0 plus G. The current stock price is $23. D0 is $1.15. Growth rate is 8%. So D1 equal to D0 times 1 plus G, right? So the 1.15 times 1.08 it's gonna be 1.24. 1.24 divided by $23 plus 8% is gonna be 13.4%. I make the the same figure, right? 13.4%, 13.4%. Okay. Then the RE, let me explain RE is on next class. So here you go. So that's the second way, the first way, and third way is the bond yield plus risk premium. So generally, which financial instrument provide higher return? In other words, which resource provide the higher cost? Cost of debt or cost of common equity? Definitely the same thing, right? Stock, let's compare stock with bond. Which one is higher return? Stock is higher return, right? Generally, right? Stock, so we say stock is higher return, higher risk rather than bond. Then, which one is higher? RS or RD? RS is higher than RD, right? So RS can be measured by RD plus something. Bond yield plus something is called as risk premium. So RS can be calculated by bond yield plus risk premium. But according to the textbook, risk premium is about bond yield risk premium 3 to 5%, but it's not common in real financial market because the current interest rate is very low. So not 3.3 or 5% is huge. I think the 1.2, 1 or 2%, around 1%, I think now 1%. But the important thing is what? Cost of common equity is higher than cost of debt, okay? And the risk premium, even if risk premium is getting, the lower and lower and smaller and smaller and smaller, but still this risk premium is the positive, okay? So the cost of common equity is higher than the cost of debt. So risk premium, we have still risk premium, but not as much as the previous one, 3 or 5%. No, not way, no way. Okay? At least 1%, I think. Yeah. Okay, that's the bond yield plus risk premium. So we have three kind of ways to calculate the cost of common equity. Okay, and next class we will talk about the cost of new common stock. So RC can be decomposed of RS and RE. We talked about RS in this class. So in next class we will talk about RE. What happened if we issue to new common stock? Okay, and analyze the cost of common equity. All right, let me stop here. Any question? Question? Perfect teaching? Okay. Blah.